Yo, what's up, everybody? I am coming to you from Los Angeles, California. Check out the surfboard right there. So, yeah, I'm going to be out here for the week in LA. Just got here today. Very nice, nice and sunny, clear sky, blue. So, a big change from New York City. Anyway, let's talk a little bit about what happened in the market today, folks. I don't know how to be more specific and exact when I talk to you guys. Like, I tell you the dates when you can expect market volatility, fluctuations, market index price rises. And it all centers around these fiscal flows. Like I tell you this in advance. It's not like I have some kind of crystal ball or I'm some magic genie. What I've been trying to teach you is that these flows, which we're talking about billions, tens of billions, hundreds of billions, trillions annually, many trillions annually. I mean, This is the core, these are the core things that drive the economy. And as the economy goes, so will the financial markets. So, setting aside personal behavior, setting aside mental game, setting aside how you personally operate in the markets, how you personally operate under different emotional scenarios, stress, excitement, elation, whatever. That's something that you have to work on, and if that needs to be, and that can also be an area of yourself that can be improved. But as far as predicting the economy and the effect on the markets, it all stems from these flows as I've been showing you. Like I tell you, mid-December, we're going to have a quarterly corporate tax drain. And then it's going to rise into the January 15th individual tax drain, which, by the way, I said that I totally, it, it went, I forgot about that. All right. And I apologize for that. And there's another one that's going to come up on January 31st. It's going to be smaller than the January 15th. And then we're going to have a February 15th quarterly interest payment. And I said that the market will rally sometime from the bottom in late December, early January into that February quarterly interest payment peak. And that would represent the peak in the fiscal flows for the quarter. And then we were going to go into that period of tax drain once again in March and in April, of course, April 15th. And that was going to trigger some volatility. By volatility, I mean possibly a correction in the market. Now, one thing I want to point out, and I think it should become obvious now, or it should start to become more obvious to you, is that these quarterly tax drains are not having the same sizable negative effect that they did last year. And I'm going to explain why. You saw how quickly we recovered off of the December 15th tax drain and then the January. I mean, today the market was already at a new post January 15th tax drain high, at least the S&P and the NASDAQ. The Dow is still lagging, but that'll come up. The reason is we are now in a completely different environment than we were last year at this time. Remember, last year at this time, I mean, the Fed hadn't even begun to raise interest rates. They started to do that in March of 2022. And then, it was like successive interest rate hikes, and it was maxi hikes, 75 basis points, which, at the time, that was a shocker to the market. And I explained to you in the past how the rate hikes initially have a negative effect, a pure negative effect, because you have to discount the value of financial assets based on net present value, right? It's equal to the cash flow and the interest rate. And the interest rate was the most impactful variable in that when the Fed first starts raising rates. Remember, when they went from 25 basis points to 50, that was 100% increase. And then when they went from 50 to a full 1%, that was another 100% increase. And then when they went, I don't know, what was it, 150? Then the percentage increase relatively became a little bit smaller. And then when they went from 150 to 2, I don't remember the exact iterations, but each time they raised it, yes, the nominal level of interest rates went up, but the percentage increase from the previous rate level shrank. Nevertheless, it was still highly negative for financial assets because you had that discounting factor, net present value, all right? But what happens, remember, if you go back, I was talking about at some point, we're going to reach an inflection point. And the inflection point was when the rate increases resulted in an acceleration in the interest income transfers into the economy. So while the rate increases were still having that negative discounting effect, the interest income was starting to accelerate, and you got to a point where you get that inflection point where one starts to exceed another. And we got to the point where I don't remember when that was exactly, but I was talking about it at the time when I believed anyway, and I think it was back in October, and that's when the market bottomed out. I said that's the inflection point, and that's when the interest income transfers into the economy were starting to have a greater positive effect than the negative from the rate hikes themselves. And we're seeing that in the numbers, like the income transfers now are big. I mean, if you look at the discount on T-bills and new issues, if you look on the interest on Treasury securities, which is, by the way, just starting, and also the fact that the Treasury can't issue new securities now because we're under the constraint of the debt ceiling. Too bad, because that would have been adding even way more interest. But we're still up like 55 billion over last year. I mean, that's big. All right? And that's just going to keep on increasing. So now, whenever you have these tax drains, number one, yeah, you're going to get a pullback because obviously when you're draining balances, there's just not as much money available to deploy into assets. But it's recovered much faster now through the normal course of government spending and the injection of that interest income flow. The other thing that's different now compared to last year is that the Fed is slowing down its rate hike campaign. I mean, we're going to have a 50 basis point rate hike in the February, and then we'll have when's the next one? In May? I'm sorry, we'll have 25 basis point rate hike in February, and then another 25 in May. And then at least the market is saying they're going to stop. So like the negative impact of the whole monetarist psychosis, because that's what it is, that's diminishing. And the positive impact of those flows, that's just accelerating. So the tax drains, we saw this in the most recent tax drain, January 15th, boom, right back up. It's a very, very good sign. A very good sign. And again, the only thing I'm worried about is the debt ceiling by mid or end of June, when Treasury can no longer employ the, what they call extraordinary measures, like basically raiding government retiree pension funds to make payments. If that results in cuts, spending cuts, that's a bad thing, because then you trigger, a vicious circle down. That's a race to the bottom. It's like spending cuts is going to reduce economic activity, which is going to reduce tax revenues to the government, which means they're going to have to cut more to stay within the whole debt ceiling thing, which it means, less tax revenues. They're going to have to cut more. It's a spiral to the bottom. And it could happen very, very quickly. So I don't know what's going to be at that point. We'll have to see. But I hope you understand now that, we're in a very good, bullish, positive cycle. From the diminishing impact of the rate situation, which I never thought was a big deal to begin with, to the positive impact of the interest income transfers from the rate hikes, which, by the way, the Fed members don't even understand. They keep thinking, hey, we're going to have to keep raising rates to slow things down. Every time they raise rates, what happens? They're just supporting the economy even more. Anyway, that's it. Talk to you later. Bye.